Hi, thanks for tuning in. This is Robert Karras of R. Karras Asset Management and Planning, here today to discuss several aspects of financial planning. In the past, we have created several videos in an effort to help individuals understand the basics of financial planning and some of the pieces involved. Today's video is titled Bonds, a Guide to Your Investment Options. We'll discuss basically how bonds work and how they fit into your investment portfolio. We are recording this video in March of 2012. Please feel free, if you have any questions or concerns, to give us a call at 216-573-3788, or you can email us at rkarras@rkarras.com. We have spoken in our previous videos on the difference between investing for speculation or gambling versus savings as a means to methodically invest for the long term. We have come to the conclusion that investing is a combination of both. Done properly, investing is a carefully planned approach to managing and accumulating money for the long term. The first step in any investment plan is to identify your goals. In other words, what are we trying to accomplish? Are we looking to accumulate assets for retirement, college, or perhaps a short-term horizon, such as a vacation or a new car? Once you identify your goal, selection of proper assets would be important to match your investment time horizons. One of the items we utilize is a risk tolerance questionnaire. This allows us to understand a client's level of comfort when it comes to risk. We all understand with investments you can't completely avoid risk, but you can manage it. This risk factor we uncover helps in deciding which individual investments are right for you. Is it aggressive, moderate, or conservative? One of the greatest investment fundamentals is the relationship between risk and return. We've assembled various investments and laddered them from safest to most risky. If someone may be very risk adverse, they should stick toward the bottom of our risk ladder. Of course, the extreme opposite would be options and futures on the top. While no one asset is right for everyone, since there is a risk-return trade-off, we highly suggest your plan be matched for the level of risk you could assume. Listed here are several types of commonly held forms of investments, ranging from the safer cash and cash alternatives to bonds, stocks, other investments, and mutual funds. Many times people think of 401k plans and IRAs as an investment. These are not investments. They are, in fact, tax advantage vehicles that hold individual investments. Bonds are essentially loans, which is why they're called debt instruments. You, the investor, lend money to the government or a corporation. The interest rate or coupon rate, which can be fixed or floating, is set in advance, and interest payments are generally paid semi-annually. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, the maturity date is also fixed, generally ranging from 1 to 30 years. Bonds don't need to be held until maturity, however. Once issued, they can be traded amongst investors like any other type of security. And because you can buy or sell bonds in an open market, bonds fluctuate in price, selling at above or below their face value. If interest rates rise, existing bonds with lower fixed interest rates become less appealing and generally decrease in value. In contrast, when interest rates fall, existing bonds generally increase in value. Generally, the longer a bond's duration to maturity, the more volatile its price swings will be. The most common type of bond issued include U.S. government securities, agency bonds, municipal bonds, and corporate bonds. U.S. government securities are backed by the full faith and credit of the U.S. government and therefore carry minimal risk. Other Treasury securities include Treasury notes and Treasury bonds, which both pay interest semi-annually. Agency bonds are issued by agencies owned or sponsored by the U.S. government, which may or may not have the backing from the government depending on which agency issues the bond. Municipal bonds are issued by local governments or states, cities, and towns. Specific authorities like a state transportation authority may also issue bonds. Corporate bonds, on the other hand, are issued by private companies. The volatility of these bonds depend on the companies that issue them and can range from very stable to highly volatile or junk bonds. Some corporate bonds are convertible and can be exchanged for shares of the company's underlying stock. You can also purchase zero coupon bonds that are issued at a discount below face value. Bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks or commodities, but they're an important component of most investment portfolios. There are many advantages to holding bonds and some disadvantages. Let's first talk about some advantages. Bonds can provide a steady stream of predictable income through interest payments for as long as you hold on to the bond. In addition, the income from interest payments is typically higher than for cash alternatives. Bonds are generally considered relatively lower risk investments. However, all bonds carry some risk, and some bonds, for example, high yield bonds, carry a greater degree of risk. Bonds may also help you to diversify your investment holdings. And bonds values tends to move in the opposite direction of the stock market. By holding both bonds and stocks in your portfolio, you might be able to offset losses in one asset category with gains in another asset category. Some disadvantages to note are, with a bond you can lose money if the issuer fails to make interest payments or is unable to repay principal, and bonds can also lose market value if the credit worthiness of the issuer declines. Many bonds are issued with a fixed interest rate, and as general interest rates fluctuate, so will the value of the fixed rate bonds. If interest rates drop, it will generally cause an increase in the market value of existing fixed rate bonds. And conversely, an increase in interest rates will cause a drop in the value of existing bonds. Finally, because bonds have relatively lower risk than other investments such as stocks, they also tend to offer relatively lower returns. As you see, there is much to consider when investing. If you don't have the time, desire, confidence, or inclination to develop and monitor your own plan, you may benefit from a financial professional. We help determine your goals, time frames, risk tolerance, and create an asset allocation plan to help you map out your future. I thank you for your time today, and I welcome the opportunity to meet with you to address any specific questions or concerns you may have. This is Robert Karras of R. Karras Asset Management and Planning in Independence, Ohio, and I thank you for your time.